Are we closer to the beginning of the end of the beginning? What do you think? Where are we in terms of an ultimate bottom? I know that we can talk about individual names, Cameron, but just bear with me for a second. Where are we in terms of either duration or how much further we need to go in close to what you would think is the ultimate bottom?
Sure. So we've certainly made a lot of progress of taking a lot of the air out of this market, considering that we've taken valuations from 22 times to start this year down to about 15 times today. But we think that there's still work to be done on the earnings estimates front because we still really haven't seen those cuts happen to 2023 earnings yet. And so as we move through what is likely an earnings revision down cycle, that could be the source of further volatility or downside for this market. Now, that's the medium-term trend, that down pressure on valuation, down pressure on earnings. But we can, of course, have these bear market rallies, these short-term relief rallies, because sentiment has become very bearish. Positioning is very, very light and short. And the fact that we have seen some of those technical factors getting oversold. So maybe in the near term, we get a little bit of a relief, but we think that there's still risk further to the downside simply because of those pressure on earnings and valuations. So it seems like we're closer to the end than we are to the beginning, but we're still stuck in this tough slog.
Have you done the math, Cameron, on the upcoming downward revisions or when companies actually do report earnings? You said we were at 15 times. Have you done, shave off what you think is going to come off the S&P earnings, and where are we really? Where are we really? We're not 15 then. We must be 18 or 19 based on where earnings are headed.
Yeah, I think that's exactly right. Because if you look at 2023 estimates, they're still sitting at about $243 a share. So that gets you about 15 times today. If you assume flat, that gets you to 16 and a half times today. But if you assume a recession, a normal kind of run-of-the-mill 10% down in earnings, which would be rather mild, you're looking at 18 and a half times for 2023 at $200 a share. So that's where the risk comes in, where we reflect the real environment for earnings, where you're seeing leading indicators in housing, in PMIs point to much weaker earnings growth. And the dollar as well. The dollar is a meaningful headwind to S&P 500 earnings because of its impact on revenues. So we think overall, probably looking towards that $200 makes more sense, which means that today's valuation still is stretched, mostly in the context of a very tight Fed.
Just looking at rates right now. I mean, the market was up 200. We're now up 50. Cameron, and I don't know what 369 now on the 10-year, so that's not that. I guess we don't need to always look for a reason if something goes from up 200 to up 50, but we certainly have on a Friday in late September. How much confidence do you have that early morning green lasts throughout the session? We can't have a high degree of confidence.
Yeah, we've learned this week that we can see some really powerful reversals intraday and not to read too much into one-day moves. And so that's when, if we do see a little bit of a breather in yields in the dollar, it's likely that we see a breather in stocks as well because there has been that inverse correlation. But if we go back to that discussion on tech stocks, I think it's an important one to note that based on the valuations today of things like growth stocks trading at 22 times earnings, they're still trading at valuations as if we had a much more accommodative Fed and as if real rates were far lower. They're trading as if real rates were about 0%. Real rates are now 1.6%. So looking through some of the day-to-day oscillations, we think that there's still risk to valuations as they price in the true environment of a very tight real rate environment, which means that growth stocks should trade closer to 17, 18 times at best, which is where they were the last time that real rates were at this level.